The 10-year this year. Jim Karen of Morgan Stanley says, yes, I think we have. Euro dollar, have we seen the lows? 101.91. We're negative 0.7%. The lows right here, right now, this morning. You've got to go back to 2002 to see these kind of levels. And crude breaking down again. We had an 8% move yesterday. We're down 1.5% now, 97.89. Ed Morse at Citi, base case, back to the 80s. The why? The demand side of the story, he sees that breaking down. We can talk about that again a little bit later. At the opening, about 40 seconds in, let's get you some moves and a breakdown. Here's Abby.
John, well, we do have that S&P 500 ever so slightly higher right now, heading to a potential third update. If so, the first three-day winning streak for the S&P 500 going back to May. A big piece of this, Apple. Now, Apple had been down closer to 1% not so long ago, but with yields lower, perhaps investors taking a look at these tech-heavy stocks. Amazon flipping back and forth, and of course, they have struck that deal with Grubhub to offer Grubhub membership to Prime members for 1 year. That's dragging on Uber, down 3.3%, and then Tesla, well off of its lows, at the lows, down more than 1% right now, down about 0.5%. This, of course, perhaps a delayed reaction to that delivery miss for the June quarter. The big deal, though, here, John, again, Apple flipping higher, the big market weight as yields are lower. Let's see whether or not the bulls can stick around for the full day.
Abby, thank you very much. We talked about the single currency, the euro breaking down. Sterling, it's bouncing back a little bit at 119.22. That currency pair, the lows of the session, 118.76, still down about 0.2%. The story for sterling, the politics aren't exactly shaping this right now, but the politics in the UK right now aren't great for the Prime Minister. Another 5 UK ministers have resigned in a group. You're getting used to this, aren't you, in the last 24 hours? Started with Chancellor Sunak and others soon followed. It's been a drip feed since then in the last 24 hours, and the pressure is building on the Prime Minister and building on the Prime Minister. We'll touch on that through the day on Bloomberg TV and on Bloomberg Radio. The Prime Minister in a tough spot. I'll tell you where he would perhaps rather be. Sun Valley. And I can tell you who's at Sun Valley right now. Ed Ludlow. Ed joins us right now. Ed, you've got a good gig, sir. Walk me through it.
Yeah, it's interesting what's going on here, John, because the world's very different to how it was 12 months ago, right? We're talking about deals, we're talking about valuations that are depressed across TMT, yet everyone I'm talking to is pretty upbeat. They see opportunity in all of it. I think we're going to talk a little bit about the news flow, which has been very heavy as well. Sources telling Bloomberg overnight in the chip sector, for example, that US officials have been pressuring their Dutch counterparts in the Netherlands to prevent ASML, that's a chip equipment maker, from giving some of their legacy and older equipment, DUV or deep ultraviolet lithography, a system for making pretty basic chips that go into cars, preventing them from selling them to China. China's response overnight, John, was to claim that this is technological terrorism, quote. I look across the notes that are out this morning and the street seems pretty sanguine. They don't see an outcome in which the US can orchestrate another European nation from not doing business with China, and there's a pocket of strength in the market overnight. But what's interesting, the themes here in Sun Valley are tied pretty closely to what we're seeing in the chip sector, right? There's a conversation around boom and bust, and you look at the performance of the Philadelphia Semiconductor Index year to date, the underperformance relative to the broader technology sector. This has always been a boom and bust industry, and you draw parallels to streaming, and what we're hearing from executives here in the read across is we're not convinced that the consumer's gone home yet, John. There's still money to spend. And so when we look at these two industries, semiconductors and streaming, and yeah, maybe I'm joining a little tenuous link, but we're looking at the same factors. How much more of these sectors got to run? And people here seem pretty upbeat.
Nothing tenuous about it, Ed. Great work. Awesome, buddy. As always, Ed Ludlow. Looking for more from Ed throughout the day from Sun Valley. I'm looking at this note from Jordan Rochester of Nomura. New target on sterling, 115 by the end of July. This is pound sterling, 115 by the end of July towards 110 by the end of September. That's Nomura. Right now, sterling 119.28, down about 0.1%. Goes on to say several factors explain why sterling should underperform its peers, and those include the fact that the UK has raised taxes, others haven't. Goes on to say, combine this with lower gas flows, a lower euro, lower risk sentiment, and global recession fears, and sterling is likely to fall below their target of 118. They're short, they target 115, they look for a move towards 110 by the end of September. brutal stuff. What we're looking forward to right now in this equity market is earnings next week. JP Morgan, July 14th. Katie Lyons, is that the next shoe to drop for this market?
Well, that's the question, John. After we already had the worst first half since 1970 and an equity market down 20% year to date, is earnings season going to make matters better or worse, considering that we do get those reports starting so early in the second half? And of course, this market is so focused, John, on the risk of an economic recession. Yet when you look at earnings expectations, no earnings recession is currently forecast. Yes, profit growth is expected to slow in the second quarter to something in the ballpark of 4.9%, but then it's seen picking right back up again, more than 10% on the year, or around $2.27 a share. Even though, according to Data Trek Research, when you look at what corporate profits typically do in a recessionary period, they usually fall about 25%. Nicholas Colas over there saying that even in a downturn that's milder than most, you could see earnings down 15% to around $188 a share. And if you apply an 18 times earnings multiple on that, you get an S&P about 33.86 in the mild recession scenario. So it raises the question of whether the bar is too high. Analysts either holding steady or even raising their earnings estimates instead of cutting them. We can see that in the blue line there. The white line is the percentage of companies beating expectations, and that has moved lower. So are analysts overconfident? Are investors underconfident? I guess we're going to start to get the answer to that question next week, John.
We can have a look ahead right now. Katie, thank you. Jonathan Gulliver, Credit Suisse, cutting his S&P price target for the year to 4,300, running the following. We reiterate our 22-23 EPS estimates, implying 12.2% and 8.5% growth respectively. Our target is being adjusted lower to reflect the higher cost of capital on valuations. It is not about recessionary concerns. I'm pleased to say that Jonathan joins us right now. John, good to catch up, sir. As always, only recently you said perhaps double-digit gains in the back half of this year. Walk me through how the thinking between you and the team has changed in the last couple of weeks.
Well, I think that there's really two stories this year, John. The first one is that really from January 1st through mid-June, the reason stocks were under pressure, let's say the first 15% or so of this decline, was because interest rates rose way more than anybody thought that they would, and that any cash flow that gets discounted at a higher interest rate is worth less money. But in the last, let's say, couple of weeks, 2-3 weeks, you've had something very different than it, which is what Katie and you and Kaylee and you are talking about, is that this recessionary fear is overtaking the market and convincing us that there's going to be something cataclysmic that's going to happen, and we think that that's not going to play out, and that that portion of the pullback, you get that money back, and the stock market's going to rise between now and the end of the year.
John, you're not looking for a catastrophe, but you acknowledge that we could get a meaningful slowdown. And the pushback I got from your note yesterday when people went through it is, how on earth is he not revising lower his earnings estimates? So, John, can we talk to that? How can you acknowledge the meaningful slowdown and that does not translate into any kind of cut to your earnings estimate?
Well, first of all, you have to look at the data. And so the thing which correlates the most with corporate profits is or not corporate profits, but actually earnings surprises, is the ISM. And an ISM, again, even though it's lower than it was at 53, it's an expansionary territory, and it's historically consistent with decent earnings beats for the remainder of the year. So that's number one. Number two, we look at analyst estimates, and I know there's a lot of discussion about analysts cutting their estimates, but it's just bad math the way people are thinking about this. The way that things normally work, and you know this, is that as you enter earnings season, companies pre-announce negative news. If they have good news, they hold it until the day of the announcement, but negative news happens early, and the estimates always fall going into earnings season, and then you get a beat when the good news comes out later. The size of the negative revisions, the negative adjustment to earnings, is smaller than historically average, meaning that the data is actually coming in better when you compare it to history for second quarter profits. The third issue that we're looking at is that when you actually start to slide into a period of weak earnings, the analyst estimates start to break apart. What I mean by that is you start to see that one analyst and another start to have numbers that start to vary widely. One is confident, one is not, et cetera. We're not seeing that kind of analyst dispersion that is consistent with an earnings recession. So when I look at the hard data rather than listening to the news flow or the panic, it all tells me that we're in a slowing economy, but nothing that looks recessionary, and that the earnings hold up fine.
John, you came very close to saying, or rather than listening to you, but I'll let it slide. I just want to come up with some counterpoints, John, just quickly. You mentioned the ISM. It is above 50, but the new orders component, as you know, dropped below 50. A lot of people would view that as a leading indicator for some pain still ahead. And forgive me for cherry picking, but I will anyway, and that provides a little bit of pushback for you if you want it. But for some of these companies, they haven't been pre-announcing. I can only really think of one major one, and that's been Microsoft off the back of this strong dollar. I imagine others are going to have to follow this earnings season. But when it comes to the retailers, John, they haven't been able to forecast any of this. In fact, they come out and downgrade on earnings day, the outlook, and then a month later, some of them have had to revise guidance all over again. And John, that makes people nervous. And what you see in the price off the back of that is massive gaps lower in the equity. Clearly not a lot of this is priced at all in that regard. What's the counterpoint to that, John?
Well, so let's take a look at last earnings season, the first quarter. We had a 6.7% beat during earnings season, which was above normal. But if you look at the weakness, there really was no. So let's just kind of dig into first quarter a little bit, because it's the best preview we have. The revenues on the S&P were up 14%. Earnings were up 12%, which means you got some negative margin issues, but there was no real single underlying trend. You had a number of areas like energy and materials, which were, gangbusters, and then you had a couple of areas, like you mentioned, consumer discretionary, which was just terrible. And what's somewhat concerning about the consumer discretionary sector for me is that the demand, consumer spending, is weaker in the second quarter than the first quarter, and yet the first quarter had really poor earnings for consumer stocks. So I think that you very well could see in the second quarter continued weakness across consumer sectors, but it doesn't mean you're going to see it everywhere. I'll tell you another area of weakness, which is that the big cap tech did really poorly. But what is interesting is if you look to and you mentioned this a second ago, the second half of the year is expected to be better, and the big driver of that is actually a rebound in financials in the second half of the year.
John, I want to fit this in, and it's really a question about your process, and it's really not a criticism. You've come in from 4,900 down to 43. It's been a really tough year so far in the S&P. We're down about 20% as things stand at the moment. Is there a point on the calendar where you'd be able to acknowledge, I've been wrong, this is a dead year, this is not going to be the rebound that I've been looking for? Could you tell me how you would understand, as you interpret the data, when and how you might be wrong here?
Well, sure. Listen, I'll tell you right now where I've been right and wrong. So the earnings numbers, when we put out our earnings estimates, they were way out of the pack in terms of being very strong. And the argument was that nominal GDP, higher inflation, and strong growth would ultimately drive really strong profits. Those numbers look like they're very, very much on track with trend. So that's really been dead on. Our sector calls, we took down technology from overweight at the beginning of the year. That was a good call. We went underweight financials this year, which proved to be a really good call. What we got wrong, the interest rate jumped way more than we had anticipated, and the valuations got just demolished. And I think the fact that we lowered our numbers is acknowledging, listen, we want the Fed, or the Fed talks about being data dependent, and as strategists, we have to be data dependent as well. And when you have a meaningful increase in your discount rate, you have no choice but to adjust your numbers and basically say, this part I got right, this part I got wrong. But that doesn't mean we're going into recession because stock prices haven't performed. And that's really where I remain somewhat constructive.
Still constructive. John, I appreciate the honesty, the transparency, just working through your process as we work through this year. Jonathan Golub there of Credit Suisse. It's been a tough year for the bulls. Getting pushed back right now on the Bloomberg. What some bulls might be missing. Here's one take for you. Is that energy estimates has revised up and offset weakness elsewhere. Once energy rolls over, put a fork in it. I think that's the less constructive view at the moment. Coming up, a host of US economic data on deck this week.
I expect a really horrible summer in terms of the data deteriorating far faster than people expect. Until the Fed really switches and gets off fighting inflation at all costs, I think they're missing all these little hints that there's problems in the economy.
We've got some PMIs to talk about, and they deliver a bit of an upside surprise. That conversation up next. Getting some economic data for you. Here's Mike McKay with the latest. Morning, Mike.
Good morning, John. Well, the whipsaw view of whether we're not or whether we are in recession gets another whip today. The S&P Global PMI Index for Services rises instead of falls in the month of June. 52.3 was 51.2 last time, and the composite index for them is 52.3, and that was 51.2 the last time. So we see the S&P ISMs or PMIs rising, sets the stage for the ISM Services Index at the top of the hour.
Mike McKee, thank you. Looking ahead to that data at the top of the hour. Mike McKee's going to break that down for you. Ashok Bhatia joins us now, Neuberger Berman, Deputy CIO of Fixed Income. Ashok, always great to catch up with you, sir. Given the data that's coming in, can you say with conviction, confidence that we may have already seen a peak on a 10-year yield or not?
Yeah, we think it's a decent chance we've seen the peak and, the peak in Fed hiking expectations, and that, we'll spend a bunch of time circling around, a 3% 10-year note. And, I think the biggest issue and the thing the bond market is wrestling with is the Fed has been, and I think Jonathan Golub was talking about this, the market or the Fed is really focused on the current data and the current inflation, and if and how the Fed will move to start to look at a lot of market indicators like crude oil and inflation break-evens and slow down the path of hiking. And the bond market is starting to price that and wrestle with that. And that's been the key driver for why, we've had this, 70 basis point fall in rates from the peak just a few weeks ago.
It's been a massive move. Ashok, I just wonder from your perspective whether a bet on treasuries, and you've captured that move lower in yields, I know, is that a bet against the Fed?
I think it's a bet that the soft landing thesis, which is obviously very out of favor here right now, is still, it's a higher probability than the market expects. Our base case at Neuberger is still that the U.S. economy can have something that avoids a recession or any sort of kind of very significant slowdown, different for other regions of the world. But, a lot of the things that are going on now, it's pretty interesting that inflation break-evens they're closer to 2% than they are 3%. We've obviously seen the move lower in energy prices and gasoline prices. And to the extent we see a little bit weaker data and start to see the fall in inflation, that a fall in inflation is pretty much guaranteed in the second half. The debate is about the speed of it and where it ends up. But those things come together, and depending on how the Fed reacts to it, it can allow the Fed to be a little slower and, bring some more stability in all these financial markets.
Ashok, I wonder what that actually tells us, though. Is that a market that's basically saying this Fed has already done the damage, it only needs to go so far to cause even more damage, and break-evens are already rolling over? Because if I throw in credit, it's a less constructive view, isn't it? Credit spreads have been breaking out. They've not been coming in. We're at 580. So you've walked me through where you are on treasuries. Can you walk me through where you are on credit, given how we're priced at the moment and given the direction of travel?
Yeah, I think for credit, our view is that, the next thing, and we'll see this in the second half, is better performance from credit markets. And, the need for credit markets need rate stability. They don't necessarily need, significantly lower rates from here, given where, high yield index is at, just under 9% in yield, investment grade credit, 4.5%. So credit markets first need some stability in interest rates, and that will be the big driver. And then second is, I think, hearing a little bit more or getting a little bit more confidence in the at these spread levels, we continue to examine expected rates, and our expectation is even in a recession, credit is going to hold up from a fundamental perspective better than the market seems to think. So we think the next phase of this for the bond market will be stability and tighter credit spreads.
That's the hope, and that's the hope that I can say the equity investors have as well. Ashok, fantastic to catch up with you. Bit of a technical issue there just at the end. My apologies for that. Ashok Bhatia there of Neuberger Berman. That is the second guest this hour who thinks we may have already seen a peak in the 10-year yield. That peak, of course, very close to 350 back in June. Right now, your 10-year, bringing it up on the Bloomberg for you. Your yield is 282. Yield just bouncing back a little bit off the back of that better than expected PMI and ahead of an ISM at about 7 minutes time. The ISM services read just around the corner. Your trading diary is as well from New York. This is Bloomberg. about 25 minutes into this morning. Good morning to you. Given the size of the moves this year, this is nothing, isn't it? We're negative about 0.2% on the S&P. On the Nasdaq 100, down about 0.1%. Going into some really important economic data over the next 48 hours or so, into claims tomorrow, then onto payrolls on Friday. That's the price action. Here is your trading diary. At the top of the hour, the ISM Services and JOLTS job openings coming up. Guy Johnson and the team will break that down. The latest Fed minutes due out at 2 Eastern time. President Biden speaking from Ohio this afternoon. We'll get another round of initial jobless claims Thursday morning. Coming up tomorrow. Finally on Friday, it's the main event. It's the payrolls report, and the team just telling me the median estimate in our survey so far, 265,000 for that number. 8:30 Friday morning. Tom Keene and I together in DC tomorrow. Looking forward to that. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day, Wednesday, July 6th. Here are the top market stories we're following for you at this hour. Bojo digs in. UK Prime Minister Boris Johnson vows to, quote, keep going in the face of calls for him to quit and talks of a potential new confidence vote after a wave of ministerial resignation. Bonds in flux. 30-year Treasury yields have dropped below 3% following an inversion in the 2s10s yield curve. What exactly are bond traders pricing? We're going to discuss all of it. Gas prices, meanwhile, take a breather. European natural gas prices halting their rally after Norway's government intervened to end an energy worker strike, and Germany took steps to ease its supply crunch. From New York, I'm Kriti Gupta with Guy Johnson in London. Alex Steele is off today. Welcome to Bloomberg Markets. Guy, I keep feeling like I'm hosting the show with you, and every single day I do, a new piece of history is written. At least that seems to be the case in the UK today.
We may see it a little bit later on here in the UK. We're certainly watching what is happening your side of the pond very carefully right now with the data that are breaking. So let's walk through the numbers. We need to figure out whether we are late cycle or whether we are recessionary. Maybe we're starting to get some clues. The ISM Services Index declines from 55.9 down to 55.3. The market was looking, the economists were looking for 54 on the nose. So a number that is slightly better than anticipated, but still a slowdown. But actually, this is not the kind of slowdown we were looking for. Really quite a good number, I think, in terms of what is happening in the service sector in the United States. There was this idea that we would slow down to a more maybe sustainable pace with the services sector, but that would have inflationary impacts. So just breaking down that number as well, the index falling, though, to its lowest level since 2020. Orders index falling to 55.6 from 57.6. So quite a big drop there in terms of the component parts. The activity gauge rising to 56.1 from 54.5. So a mixed set of data coming out of this services number on the ISM. Prices paid at 80, down from 82.1. So a softening in terms of the inflation, but actually the headline number still relatively strong. The JOLTS number, which remember is very rear mirror in terms of the date the data was taken on, but we are still at 11.25 million jobs open in the United States on the JOLTS number. The prior number revised up a little bit, so actually we are tightening the labour market maybe a little bit more quickly, but nevertheless still a very tight labour market. There's a lot to work through here in terms of these numbers, particularly in terms of the ISM. Treasuries are extending their slide after that ISM services number comes in and beats expectations. The component parts, though, are important. So let's talk about our question of the day, Kriti, and figure out what is happening here. Is this what a recession feels like? Well, maybe today's services data tells us that we are not anywhere near a recession, despite the fact that I've heard an awful lot of commentary about the fact that we are in a recession now already on Bloomberg Television today. Bloomberg's international economics and policy correspondent Mike McKee joins us now, of course, ahead of the Fed Minutes. Ira Jersey, chief U.S. rate strategist at Bloomberg Intelligence, back at his usual perch in Princeton. Mike, what do you make of the data? Well, Guy, it does surprise that the services industries remain as strong as they do, but you wonder if some of this recession talk isn't people on trading desks who have lost money because the markets have gone down, whereas the average American is still feeling like they can spend. A couple of interesting points in that services number. One is employment. It does slip into contractionary territory, but is that because people aren't getting hired or because companies can't find people to get hired? That was the intimation from the ISM people from the Institute for Supply Management. Also taking a look at exports. Exports drop, and so do imports. Now, the big reason we saw recession, or at least a contraction in the first quarter, was because exports were so much greater than imports then that we are so much smaller that it subtracted from growth. So if that is going to reverse, then that is better news for second quarter growth.
Ira Jersey, hop in here because just as Mike McKee was talking, we were getting that data out. The reaction in the bond market is pretty crucial. A major sell-off across the curve. You are seeing the 10-year yield back up to 285. And this, of course, comes after that inversion that we saw yesterday. I believe the 210s remains inverted. Is this the price action that we should be seeing at this stage of the cycle?
Yeah, so this is kind of mid-cycle-ish kind of levels here for the yield curve in general. I think it's interesting that you've seen such a large turnaround. You know, this morning we were rallying because you had a pretty decent rally in Europe, and everyone was worried about a recession coming. And now, just in the last half hour or so, we've seen a pretty substantial turnaround here, with two-year yields now up by almost 9 basis points after having been down a little bit, right? So the inversion, I think, is important because it is signaling that the market at least is thinking that the Fed at some point in the not too distant future is going to hike too much and then have to take back some of those cuts. And that's the reason you see a lot of this inversion in the curve.
Ira, we are all over the place. The market doesn't know where to go next. We've got a Fed that is clearly trying to figure out what the landscape looks like with inflation. We've got a market that's trying to second guess the Fed, trying to second guess the data, and consistently, in some respects, and today may be a good example, getting it wrong. We're all over the place. Why?
Yeah, I think liquidity has been very poor basically since the Federal Reserve stopped its asset purchases, and now it's just going to be worse. Remember, last Thursday we had the first big round of quantitative tightening where you didn't see the Federal Reserve reinvest a lot of its coupons that were maturing. So you're in an environment where you're just going to see 10, 12, 15 basis point moves more regularly across the yield curve, in part just because there's a lot more bonds outstanding. And like you said, Guy, I think the market is still trying to figure out, like, hey, are we going to continue to be in a low interest rate environment, or is inflation going to be somewhat more persistent? And because of that, we'll wind up seeing yields move even higher. Now, my view is that we may have seen the peak in the 10-year yield, but I don't think we've seen the peak yet in the 2-year yield. So I do think that the yield curve in general could get significantly more inverted as we get deeper and further into this business expansion here.
Before we go back to Mike McKee, Guy, I want to point out, just a couple of days ago, I had a conversation with Mike about what exactly defines a recession. I feel like in the markets have kind of been taught that it's 2 negative quarters. Mike McKee said, yep, that's cute, that's adorable. That's not what it is. It's actually, you can't actually tell until you're out of it. You can't tell in retrospect.
Historically, yeah.
Exactly. And
you can only do it retrospectively, basically.
Exactly. And, I think as a market participant, naturally, investors don't necessarily think in that direction. They're trying to time this out so perfectly. But Mike, let me bring you back here, because in addition to correcting my logic there, the first answer earlier when you spoke to Guy was very much in the economist take. I have to ask, could these economist take actually be wrong here? Could the market be right in that perhaps we are in a recession right now and the pricing that you're seeing is 100% on the dot?
Well, economists can go either way, of course. We are two-handed, but I think in this case, there is very little chance that we are in recession right now. The numbers are still strong enough on the consumer spending and business investment side and in the labor market that it would be hard to call a recession. Now, the National Bureau of Economic Research is the arbiter of recessions, and they usually take a couple of years to say when one began and one ended. But unless the employment data in particular were revised down, it would be hard for them to do that. I do have to make a correction, Critty. Not a correction, but a clarification. Sure. It is not an official definition to say 2 consecutive quarters is a recession, but we have not had a recession that didn't have 2 consecutive quarters of negative growth together. So you can back into Mike, it and say maybe it's worth looking at.
Let me put it another way. You normally feel a recession before it is confirmed. Does this feel like a recession? Have we ever seen a recession when you've had a ISM services index that prints 55.3? Because Ira just said this is mid-cycle. These are kind of mid-cycle numbers, not even late-cycle numbers.
Yeah, I mean, they are essentially, we're seeing mid-cycle numbers. You look at the first quarter GDP numbers that got everybody worried that contracted. Well, business spending expanded by 10% for non-residential fixed investment. That's not a recessionary kind of number. Again, going back to that chart I showed earlier, it wasn't just exports that fell so dramatically. It was imports didn't move a lot because companies had imported so much in the fourth quarter. All the stuff that had been backed up at the ports finally got here. And so inventories add to growth. They didn't last time, and so that also cut the growth figure in the first quarter. Inventories and exports aren't something that are really going to impact the average working person. It's been interesting to me to see the confidence numbers so bad, and I think it's probably partly recency bias in that things were never this bad for a couple of decades. I mean, it's the 70s and early 80s that we saw the Volcker inflation, and because gasoline prices got so high. But if you've noticed lately, in the last 2 weeks, gasoline prices have started falling.
They certainly have, and of course, as we compare that to the recessionary dashboard, layoffs, et cetera, it'll be interesting to see which side is right, the economists or the markets folks. Bloomberg's Michael McKee and Ira Jersey of Bloomberg Intelligence, we thank you as always. Coming up, Wall Street's debating when a recession will hit. We just had that conversation. We'll get more of it. Many consumers feeling like, well, we're already there. We're going to discuss that with Joe Gilbert of Integrity Asset Management. And in the meantime, we're going to keep an eye on what's going on across the ocean. You're looking at a live shot right now of British Prime Minister Boris Johnson facing more tough questions this time from a select committee in Parliament. We're going to have all of that coverage ahead. This is Bloomberg.
Actually near the top of the growth league. But I think percentage rather than absolute. Yeah, sure. But the
This week, all eyes are on Sun Valley, where the titans of tech and media meet to talk business. And Bloomberg will make sure you're part of the action with live coverage and impactful interviews. It all starts Wednesday, July 6th, right here on Bloomberg.
Today's Bloomberg Big Take focuses on the state of the economy while Wall Street debates when a recession will hit. Many consumers are already feeling like they're in one. They take us back to our question of the day. Is this what a recession feels like? We're going to ask that to Joe Gilbert, Integrity Asset Management Portfolio Manager. Joe, thank you as always for joining. It's interesting when you look at the recession dashboard here, when you're looking at layoffs, a crunch in a business investment, when you're looking at simply how much spending ability the average American has, and then kind of combine that with what the market is actually pricing in. Joe, is this what a recession feels like?
Hi, Creed. Thanks for having me on. I think right now we really have we're kind of in flux because traditionally this is not what a recession feels like. There's usually more job loss at companies but right now I think that, we had the first quarter, which trended a negative number, GDP. This quarter, we're possibly most likely going to do it as well, which is a technical recession to an extent. I guess Mike has already said earlier that, we've never had a recession without 2 consecutive negative quarters. But I think right now we have consumers, we've had a fair amount of demand destruction. So I know when we talk about gasoline prices rolling over, that's rolling over because you've gotten to a point where demand has been crushed. So I think on the margin, is this a typical recession? Not in a typical sense, but I think what we are seeing right now is probably more of a shallower, not as long in duration recession.
Yeah. Okay, so Joe, where are we in the cycle? We've just seen data from the ISM, the services number, which Ira Jersey described as mid-cycle. Are we still mid-cycle? And if so, how do I invest if it's mid-cycle? Are we late cycle? If it's late cycle, am I correctly positioned? If I'm in a recession, how do I want to position for that? Where do you think we are in the cycle? What does the data tell you? And where do you want to be positioned for where you think the answer to that question is?
Yes. I think that we have to take a step back and realize that the data is never perfect. There's never any indication. There's no one that rings the bell at the top or at the bottom. So I think right now we're probably, the way that if you look at the equity market, especially coming out of last quarter, stocks are pretty much discounting that we're past late cycle and we're into a downturn. And the last thing to shoot a fall was energy, because as we went through the year, energy was the only sector that has positive returns. And then, last month we started seeing this degradation in the returns of not only the equities but also in the commodities. So I think that the market, at least from the equity market standpoint, is getting to a point that we're past the late cycle. We're on the verge of the downturn. And I think that's kind of also reconciled when you look at the fixed income market with the yield curve flattening now actually to a point of inversion. So we're taking triangulating all of those things, it seems that it's more likely for investors to start positioning themselves for a slighter, a downturn that won't be long in duration. So with that, I think you've had consumer staples and healthcare and utilities. Those names have already been priced up. Investors have gone out and bought insurance, and that's why these names are trading at such a high multiple to the market. So right now, we're thinking the opportunity actually lies in some of the earlier cycle names, but obviously more tactically. So when we're thinking about more consumer discretionary and financials there.
So, Joe, I'm interested to know what actually investors need to see to turn this around. I guess I'm wondering more of, you have so many different components as you do for a recession. You have an extremely tight labor market. You have a shrinkage in the workforce to some extent. You have a shrinkage in business investment. You're already seeing that with a lot of these tech companies, even Wall Street banks kind of slowing down some of their hiring and even laying people off. In addition to a major housing shortage, I'm curious at what point or what data point are investors most glued to when it comes to either predicting the end of the recession or predicting the depth of it?
That's a very good question, Kriti, and there's no perfect answer for that. I think right now investors are really, front and center on investors' mind is what the Fed's going to do. The whole adage is don't fight the Fed. The Fed has been raising rates this entire year. The equity market has had negative returns. Fixed income market is as well. You think that there's definitely correlation there. So right now, it really, I think investors are waiting to see if the Fed will make a policy error. And I think right now, we're factoring in, they'll do 75 basis points this month. And hopefully, our hope is that, they will see what, inflation numbers come in like over the next couple of months, also payroll numbers, and in September take the opportunity to have a pause. Now that's what we're hoping for. Obviously, hope is not a strategy. So I think the market is really more concerned on if the Fed is going to make a mistake and tip us too far, and that will actually give us more of an indication of if this is going to be a longer slowdown or not.
Joe, Brent's now down below $100 a barrel. That's the first time that's happened since April the 25th. The energy trade that everybody's relied on so far this year to deliver is now turning around. If energy's not delivering, how do I avoid losing money in this market? Where can I actually hide out? Because the places are far and few between.
No, you're absolutely right, and that goes back to my earlier point that, we kind of needed to see energy roll over to suggest that we have actually moved past the late cycle, because energy and materials, those names are generally later cycle names that hold up well when we're in a higher inflationary environment. So what the market is suggesting is that inflation has peaked. We are moving past those later cycle names because demand has either been destroyed on the margin, or that there is is just going to be a lot slower growth. So right now, what we're thinking about positioning-wise is consumer discretionary names, because when you look at these names, a lot of these names are trading similar to where they were in 2020 when the economy and the globe was completely shut down. They're trading close to book value. So, and similar to financial. So we think that those names are already overly discounting a major slowdown, and that's where the opportunities are.
Joe, great to catch up. Thank you very much indeed. Joe Gilbert of Integrity Asset Management, greatly appreciated. I want to take you back to Westminster here in London. Boris Johnson, the current Prime Minister of the UK, taking questions from the Liaison Committee. Oddly, and it feels odd after the events that have unfolded over the last 24 hours, they're asking him policy questions. Maybe they're moving on. I heard the word resignation mentioned just then, but up until now we've seen policy questions being put to him, which seems a little bewildering given what's going on outside the room. Anyway, let's take a listen as we head into break.
Conservative MPs that you're beyond Gloria Gaynor, you're more the Paul Young, and you want to tear the Playhouse down. And the warning they're getting is, if it's a sure destruction of the Prime Minister, you might make it mutual. You might call a general election of a cull of Tory MPs, something, of course, that'd be very welcome in many sides. But the point of clarification and disagreement that some of us have had in light of powers being taken away from the fixed term.
British politics, front and centre. I've been on resignation watch today, I've been on parity watch today. The British Prime Minister, Boris Johnson, earlier in the House of Commons, warning that he's going to keep going. There's lots of calls to quit. They're coming from every angle. There are resignations all over the place. Plotters in his own party potentially planning a new vote of confidence that could take place today, next week. How long will Boris Johnson last? It does seem as if the writing is on the wall, but this is what he had to say in the House of Commons earlier.
I abhor bullying and abuse of power anywhere in Parliament, in this party or in any other party.
None of that explains why he promoted him in the first place. And we've heard it all before.
I'm not going to trivialise what happened. It's absolutely true, Mr. Speaker, that it was raised with me. I greatly regret that he continued in office.
So what they're discussing there was the Pincher incident, which is basically the latest element of Boris Johnson's downfall. He appointed him as Deputy Chief Whip, and it turned out that as a result, he was facing a lot of calls himself to resign because of the fact that Boris Johnson had been briefed on the fact that Mr. Pincher had faced some serious allegations and investigations. Joining us now with the latest is Bloomberg's Joe Mays, joining us from 10 Downing Street. Joe, will Boris Johnson be Prime Minister by the end of the day?
Well, that is looking increasingly unlikely, Guy. I mean, we know we have this meeting of the 1922 committee later this afternoon where they could decide to change the rules to allow a leadership vote in Johnson, which could happen even later tonight or indeed tomorrow. But it could be the case that if Johnson sees that's coming, he might think, look, the game is up and I should go. And we have reporting at Bloomberg saying that more cabinet ministers are threatening resignation if he doesn't go, ahead of that rule change. So this could be Boris Johnson's final day as Prime Minister. That's true.
Joe, speaking of that rule change, I mean, just for our international, specifically our American audience who aren't familiar, this is for the 1922 committee, if I'm not wrong. Talk to us about the odds here that new confidence vote does actually be brought up to as soon as next week. What kind of numbers, what kind of support or lack thereof is Boris Johnson looking at?
Yes, so the 1922 committee sets the rules when Tory leadership elections can happen, and we know that currently the rules say if you survive a confidence vote, there's a year until you can face another, and that's what's protecting Johnson right now. It's looking pretty likely that those rules would change tonight, either by the chair, Sir Graham Brady, deciding that this has to happen, and then we are into a vote. It could be next week, it could be tonight, it could be tomorrow, and then the wide expectation is Johnson would lose that vote. It's recognised 40% of his MPs voted against him in June, and since then we've had 28 resignations in the last 24 hours moving against Johnson. If that number were to shift into the no confidence column against Boris, the game is over.
Understood. Bloomberg's Joe Mays giving us all the information from Westminster. Thank you as always. We're going to check in with him later and bring you constant coverage. This is Bloomberg.
This is Bloomberg.
We're about an hour into the U.S. trading session. Bloomberg's Abigail Doolittle is tracking the moves. Abby.
Well, Creedy, we do have flip-flopping moves at this point. The S&P 500 trying for its third up day in a row, up ever so slightly. This, of course, after being up and down in the pre-market. Right now, if it does hold that tiny gain, the third up day in a row, the longest winning streak since the end of May. You can see the NASDAQ 100 indecisive. What is very decisive, though, is oil back below $100 per barrel, now at $96.50 on a technical basis below the 100-day moving average, suggesting oil will slip to that 200-day moving average closer to $87 per barrel. This, of course, on fears of a global recession, demand slowing. That's really weighing on oil. And you can also see that the 30-year yield right now at 3.09%, but earlier it was below 3% on a bit of a haven demand. Let's take a look at some of the specific sectors that we have going on in here. And first, we're going to take a look at volatility. What we're looking at here in white is the VIX, or the volatility index for stocks. In blue, the MOVE index, volatility for bonds. And then in yellow, the foreign currency volatility index. You can see all are elevated. Really, the VIX not so much at all. But currency and bonds, much more so. Bonds truly elevated. This, of course, after we've had these massive moves in yield, that 10-year yield, the last time I looked, and it's probably moved since then, below 2.8%. So it's going to be interesting to see what happens. As for those sectors, here we have weakness on fears of a recession. The autos component index down 1.9%. This is GM, received a negative suggestion from a Wall Street bank. The consumer services index down. This as the airlines down 1.6%. Of course, airline travel absolutely snarled. And then the super composite trucking index down 0.7% as the big truckers, the 18-wheelers orders are sharply lower. And then finally, rounding it out, all this has one thing potentially in common, and that is the idea that a recession could be ahead. This is a Bloomberg economic model, representation of a Bloomberg economic model, and the idea that recession is very likely, 98% likely, in the next 2 years. So explaining lots of the different sector and moves that we're seeing among various asset classes, Guy.
Abigail, it's all around that recession narrative, but I have to say the services data we just got from the ISM may be indicating we're not that close to a recession. As Abigail was saying, the data certainly feeding back into the energy market in a fairly brisk way. Brent crude a few minutes ago back below $100 a barrel. That's the first time we've seen that since April. We're just flirting with that flat line right now. As you can see, we're right on $100 a barrel for Brent, but TI down at 96.75. Joining us now, Josh Young, Bison Interests CIO, Bison, an investment firm focused on oil and gas. Josh, great to have you on the program. Got Brent at 100. Is that the right price if we're heading to a recession? Are we heading to a recession?
My crystal ball's broken, so I don't know. Okay. I do know that oil does seem too low relative to very tight supplies and relative to quite healthy demand.
Josh, let's talk about the trade-off here between crude and natural gas, because of course we know in Europe there is this major crisis going on with soaring natural gas prices. But here in the States, it's a different trade here where you do have, at least for all these utilities, this idea that if natural gas is getting too expensive, they're going to kind of feed back in and help or need more crude oil. How much of that source of demand could help lift prices?
Yeah, I think it's great that you're talking about that, and it's a huge factor that hasn't really been covered that much. So this past winter, it looks like there was as much as 2 million barrels a day of demand for power and for heat, mostly in Europe, but also a little bit in Asia. And I've seen estimates of as much as potentially, and this is on the high end, 5 million barrels a day of potential demand, especially as European and Asian natural gas prices price in close to $300 per barrel equivalent. So that's a very high price relative to the current price for oil. And I haven't really seen this too much in sell-side models. And I think there's a real potential for demand to surprise. And again, you can see oil prices falling. And so it kind of sounds weird to be very bullish on oil while the short-term price is moving. But I mean, just look at the fundamentals and they look very strong.
If we were to see the Russians cutting gas off from Europe, how extended does that trade become?
Yeah, I mean, we're already seeing them cut it off to some extent. So Nord Stream 1 is under maintenance. Their deliveries have been falling off around the same time that the Freeport facility here in the U.S. that was exporting gas had an explosion. And so, we're already seeing reduced supplies to Europe, which is, I think, part of the contributor to higher European natural gas prices. And, I think, obviously, if Russia cuts off more, then that could be even more extreme. But in the current circumstance, even if Russia resumes limited flows of gas, and even as Nord Stream 1 comes back online, there could still be a pretty big disconnect, and there could still be much more oil burn for power and this winter for heat than it looks like people are expecting.
Josh, it kind of sounds like you're saying no matter what, correct me if I'm wrong, but no matter what, there is kind of this bull case for oil, similar to, I guess, the arguments we make even in the housing market, that even if there is that decelerating story, there is still a massive shortage in the markets. I have to ask, though, what alleviates that? What kind of time frame are we looking at?
Yeah, so I think better policy would alleviate it, but I wouldn't hold my breath on that. Either a very deep recession where there's so much power demand destruction as well as transportation demand destruction that you actually see the market balance out. And it seems like the market's starting to price that in right now, although, again, who knows? And it does look like maybe the short-term recession calls might be a little overstated. But in the medium term, if you see a lot more drilling and you also just see a slower global economy, that could sort of balance things out, likely at much higher oil prices than today.
A lot of people have done well by being in oil companies this year. It's been one of the few places on the stock market that has performed. They're starting to get nervous as they see crude coming down as sharply as we've seen over the last few days. What would you say to those people? Stick with the trade. If you're in that trade, where do you want to be?
Yeah, so the consensus from a sell-side perspective is that these stocks are pricing in $55 to $60 oil. Oil and gas stocks were very unpopular for many years, and they've only very recently started to outperform. So a lot of the money that's in it is sort of hot money and is new to the sector, and I think is a little bit unfamiliar with the huge volatility that we've experienced over the last number of years. And so I think there's sort of this trade-off in between accepting additional volatility while accepting additional returns. And the more volatility and the more of these sort of pullbacks that we've seen, I mean, we've seen a number of these very high percentage pullbacks since this oil bull market started in November of 2020, the more volatility there is, the harder it is for the sector to deploy capital. And the harder it is to deploy capital and attract capital, the higher the oil price needs to be and the higher the return on investment needs to be to get that capital deployed. So I think oil and gas stocks are very mispriced. And again, it feels funny saying this with oil down and the stocks down even more, but this has happened many times before, and it does look like we are in this sort of secular or super cycle bull market for oil, even as we experience these pretty painful pullbacks on the equities and on the commodity.
Josh, let's talk about the natural gas side of the equation here, because there is a almost insulation when it comes to American markets, just given that natural gas isn't as used perhaps